Hey, this is David Skrika. Just so for the paying members, I'll be doing my weekly member update Tuesday. Sorry I did not get it out this weekend. Part of it, I was just going over, because we've done a little more than usual on the members updates. And I was like, what am I going to talk about? Because I want to do something on dividend stocks. So next weekend. So I was going to do something kind of, we talked about John Templeton on maximum pessimism, but just show more examples of it for more detailed examples for the paying members. So what we're going to look at today is, we're going to look at oil. So we've seen this kind of move down in oil, from the low 90s to the low 70s. The fundamentals in oil short term aren't the greatest right here. And the reason being is there's rumors now that the Saudis are going to do a 180, similar kind of what they did in 2014, 2015. And what they did then, for those of you who are unaware, the Saudis dumped a bunch of oil on the market. They dumped oil on the market to basically crush the price to get rid of the frackers. But the problem at the time was we were still in the middle of this huge long era, really from 2009 to 2021, when we had these zero interest rates. So all these companies were, when they were, especially in the early 2000 last decade, 2000 teens, tens, where they were like borrowing a lot, they got a really low rate, and those bonds had not yet rolled over, and they still had access to cheap capital. So that, in 2015, for example, you still had almost zero rates going into 2021, it's another 6-7 years. So now I think though the Saudis did it, it would have a much more drastic effect, because these companies don't have the cheap capital anymore. Interest rates are normalized, and a lot of banks might not even lend them the money. So that's something to watch. And that could combine with, so that's number one. Number two, there's a bit of oversupply right now in the market. So we have not seen the market come down yet, the supply really come down yet. And number three, it does look like the economy is slowing, and we could be entering a recession next year, which of course means less demand. So that's the negative things. And if I go look at stock charts here, and we go look at, let's go look at the USO, which is the oil fund. You can see we're kind of in this downtrend. We've broken below the moving average. So that's the negative. On the positive is seasonality. The oil seasonality, this is a great site. I've talked about it in the past. Equity Clock. I highly, I recommend following them on X or Twitter or whatever the hell it's called now. But anyhow, you can see that Equity Clock, this is a really interesting thing. There is a chart where it shows that basically oil tends to bottom right here, right where we are now in December, and then kind of, rally really into the summer driving season into July. So, really, and it's pretty, it's pretty well, like, doesn't really see major declines. And if you go look at all the years that oil did crash, like 2008 during the financial crisis, I guess in 2020, it did happen in the spring because of COVID. So it happened a little earlier in the year than usual, but 2014 and 15, oil kind of bottomed in the fall. So it usually basically works. So the question is, are these fundamentals going to play? Will the Saudis dump, or are we kind of in the seasonal low? So we're going to have to see. And if we go look at the oil stocks, we'll look at the XOI quickly. You can kind of see they're kind of in this consolidation. They haven't broke down their moving averages. So, what's going to happen here? So I just wanted to show this. I still think it's too early to buy the oil stocks. You can see the XOI, which peaked at 2000, is 1800. So that's a 10% correction. And it's had a big low off its lows of years ago when oil went to negative. You can see the XOI is more than tripled from its low. So I don't think we're in this kind of area where it's a buy. I don't think this will ever happen again, because the whole global economy is not going to shut down again like COVID. But if we do see a slowdown and we do see the Saudis dump and oil gets back down to that $50 range or something like that, the XOI would probably be 20 to 30% lower than it is now. It'd probably be in the 1,200-1,300 range, and that's when you might want to look at it. So just wanted to show you. So you've got this combination of lower demand, higher supply, maybe the Saudis coming to the market as the negatives. And on the positive side, you've got the seasonality. So we'll see which one plays out. And like you said, it doesn't look to me personally that the oil stocks are really cheap enough yet to go after. But one thing that's good about these low oil prices is even though gold has come off, that's a huge input cost. And one reason gold stocks did so well until 2020 was that oil collapsed and stayed low for most of the year. And, they, using diesel, using, gas powered, trucks, etc. That is a huge cost for mining companies. So if gold does rally, I think in the first or second quarter next year, when the Fed begins to cut rates, and oil's kind of depressed, that will be good because that will help the gold miners' margins. So that's also something to watch out for. So everybody take care. Yeah, and members, watch out for the update tomorrow.